While most investors were fixated on headline inflation prints, AI earnings narratives, and daily swings in equity indices, something far more consequential happened in the background. Roughly $4.8 trillion quietly moved out of what we typically call traditional markets, public equities, long-duration bonds, and benchmark index-linked vehicles, without triggering a visible panic. There was no single crash day, no dramatic CNBC countdown, no emergency central bank press conference. That silence is precisely why this matters. In one sentence, the core event is this. A multi-trillion-dollar reallocation of capital occurred away from conventional market structures into alternative, short-duration, private, and balance sheet-protected channels, and the signaling mechanism most people rely on failed to detect it. Markets did not scream, they whispered, and most participants were listening for noise, not flows. The reason the crowd missed it is structural. Modern markets are no longer dominated by price discovery alone. They are dominated by liquidity plumbing. When capital exits slowly, through redemptions, maturity roll-offs, reduced reinvestment, collateral substitution, or internal balance sheet reallocation, price indices can remain deceptively stable. For example, if a pension fund lets $50 billion in treasuries mature without reinvesting and parks that cash in overnight facilities or private credit vehicles, the bond index barely reacts. Multiply that behavior across insurers, sovereign wealth funds, corporate treasuries, and banks, and you can move trillions without ringing a bell. The forcing mechanism behind this shift is not fear in the emotional sense. It is constraint-driven optimization. Since 2022, the global financial system has faced a synchronized increase in funding costs. Policy rates moved from near 0% to the 4 to 5% range in the US and comparable levels elsewhere. At the same time, regulatory capital rules, duration risk penalties, and volatility-linked margin requirements made long-dated public assets more expensive to hold on a risk-adjusted basis. When the risk-free rate offers 4 to 5% nominal, any asset that cannot clearly exceed that threshold after volatility, drawdown risk, and liquidity haircuts becomes structurally unattractive. What's at stake here is not just portfolio composition. It's how shocks propagate. Traditional markets, equities, and public bonds rely on continuous liquidity, tight spreads, and confidence in secondary market depth. When trillions migrate away from those venues, the remaining liquidity becomes thinner, more reflexive, and more sensitive to stress. That raises the probability of abrupt repricing events, even if macro data appears fine. This is how you get markets that look calm on the surface, but gap violently when a constraint is hit. It also has real economy consequences. Capital that once financed public companies through equity issuance or cheap bond funding is now increasingly channeled into private credit, short-term instruments, or reserve buffers. That changes hiring decisions, investment cycles, and refinancing risk across sectors. A company facing a 7 to 9% private credit rate instead of a 3% public bond yield behaves very differently, even if GDP growth hasn't rolled over yet. Disclaimer. This discussion is for educational and informational purposes only. It is not financial advice, does not constitute a recommendation to buy or sell any asset, and involves risks and uncertainties. Market conditions change rapidly, and readers should consult qualified financial professionals before making decisions. This is the part most people miss. The absence of visible panic does not mean the absence of stress. It often means the stress has already been internalized, just not where you're looking. To understand how $4.8 trillion can exit traditional markets without triggering an obvious collapse, you have to stop thinking in terms of headlines and start thinking in terms of balance sheets, roll schedules, and liquidity hierarchy. Markets don't move only when people sell. They move when capital stops renewing its commitment. That distinction is where almost all public commentary fails. The first mechanism is maturity runoff. Large institutions, pension funds, insurers, sovereign wealth funds, banks, and corporate treasuries hold enormous quantities of bonds that mature every month. In a low-rate environment, those proceeds are typically reinvested automatically into longer duration assets. But when yields rise sharply, reinvestment becomes optional. If a fund allows $100 billion in treasuries or investment-grade bonds to mature over a year and reinvests only $40 billion, that's $60 billion leaving the public bond market without a single forced sale. No panic, no price collapse, just absence of demand. Scale that behavior. Across the US, Europe, and parts of Asia, annual bond maturities easily exceed $10 to $12 trillion. If even 30-40% of that flow is diverted into short-term instruments, private credit, or cash-like reserves, you reach multi-trillion-dollar reallocations quickly. Prices may wobble, but indices can remain deceptively stable because selling pressure is not concentrated in time. The The second mechanism is duration aversion under higher rates. When policy rates sit at 4 to 5%, the duration math becomes unforgiving. A 10-year bond with a duration of roughly 8 to 9 years will lose about 8 to 9% in price for every 1 percentage point increase in yield. For institutions measured on quarterly or annual performance, that volatility is no longer acceptable when a 3-month or 6-month instrument offers comparable yield with near zero duration risk. The rational response is not to dump long bonds all at once, but to tilt new allocations away from them. Equities face a similar but subtler mechanism. Valuations are a function of discounted cash flows. When the discount rate rises from 2% to 6%, the present value of earnings 10 years out collapses mathematically, even if the business itself hasn't changed. Rather than triggering immediate mass selling, many allocators simply stop increasing exposure. Buybacks slow. Passive inflows weaken. Equity prices may grind sideways while real capital quietly exits through underallocation. The third mechanism is collateral efficiency. In a higher rate, higher volatility environment, institutions prioritize assets that can be easily pledged, rehypothecated, or converted to cash with minimal haircut. Short-term government bills, overnight facilities, and select private credit structures often score better on this metric than long-duration bonds or volatile equities. When collateral requirements rise, for derivatives, repo funding, or regulatory buffers, capital naturally migrates toward instruments that preserve optionality. Here's a simplified numerical example. Suppose a large insurer manages $500 billion. In 2021, it allocates 60% to long bonds yielding 2%, 30% to equities, and 10% to cash. By 2024, short-term rates offer 5%, equity volatility has increased, and regulatory capital charges on duration have risen. Without selling aggressively, the insurer allows $80 billion of bonds to mature, reinvests only $30 billion, reduces equity exposure by $20 billion through underweighting, and raises cash and short-duration allocations by $70 billion. Multiply this behavior across dozens of similar institutions globally, and you approach the $4.8 trillion figure without a single dramatic event. This is the part most people miss. Markets price marginal trades, not absent ones. When the marginal buyer disappears slowly, prices don't crash. They become fragile. Liquidity thins. Depth vanishes. And when a shock finally arrives, the adjustment is violent because the buffer is gone. That's how the mechanism works, not through panic selling, but through quiet, rational withdrawal driven by math, regulation, and incentives. The most powerful forces in finance. Once capital quietly leaves traditional markets, the system does not rebalance evenly, it concentrates stress. The most important question is not who chose to move, but who no longer has the option to move. That's where pressure builds, and that's where discontinuities emerge. Start with governments and sovereign borrowers. Public debt markets rely on a predictable base of long-term buyers, pensions, insurers, foreign reserve managers. When those actors reduce duration exposure, governments still have to refinance maturing debt. In the U.S. alone, Treasury refinancing needs in a typical year range from $7 to $9 trillion, depending on deficits and maturity structure. If a meaningful portion of traditional buyers step back, the marginal buyer becomes shorter term, more yield sensitive, and more tactical. That raises rollover risk. Either yields rise to attract demand, or issuance shifts toward shorter maturities, increasing future refinancing pressure. There is no third option. Either borrowing costs go up, or duration risk compounds. Banks are another pressure point, but for different reasons. Post-2023, banks face tighter liquidity coverage ratios, higher capital charges on unrealized losses, and increased scrutiny on duration mismatches. Many are trapped, holding low-yield assets purchased in a 1-2% rate environment while funding costs float closer to 4 to 5%. They cannot easily sell without realizing losses, and they cannot easily grow without taking new risk. The result is balance sheet contraction. Credit availability shrinks, not because banks are pessimistic, but because their constraints force them to conserve capital. Now look at leveraged funds and market makers. These actors depend on stable funding and deep liquidity. When trillions migrate into short duration or off-market structures, repo liquidity becomes more expensive and less reliable. Margin requirements rise, haircuts widen. A fund running 5x leverage on a strategy that earned 200 basis points in a low volatility regime suddenly faces a math problem when funding costs increase by 150, 200 basis points. Either leverage comes down or the strategy becomes unviable. Deleveraging is not a choice, it is forced. Corporations, especially those in capital-intensive sectors, are also caught. Between 2025 and 2027, a large refinancing wall exists globally, with trillions in corporate debt maturing. In the old regime, refinancing at 3 to 4% through public bond markets was routine. In the new regime, access is uneven. Large, high-quality issuers may still tap markets, but at 6 to 7%. Lower quality issuers face private credit rates in the 8-12% range or are shut out entirely. The binary choice becomes clear: cut investment and headcount, or accept higher debt service and risk future distress. Households feel the pressure indirectly. Mortgage rates near 6 to 7% reduce affordability, even if home prices don't crash. Consumer credit tightens as banks protect balance sheets. Wage growth may slow as companies prioritize liquidity over expansion. None of this requires a recession headline. It emerges from constraint-based behavior. A brief historical parallel helps. In 2006-2007, capital quietly shifted away from certain structured credit products long before the crisis became visible. The difference today is that the assets being avoided are not exotic. They are mainstream public markets. The similarity is structural. Liquidity retreated before prices collapsed. The key difference is that today's system is more regulated and better capitalized, which may delay the breaking point, but also concentrate stress when it arrives. This leads to the binary framing. Either liquidity returns to traditional markets, or the system learns how to function with much thinner buffers. There is no stable middle ground. Pressure does not dissipate. It migrates. At this stage, the narrative only matters if the math supports it. So let's strip away sentiment and walk through the flow arithmetic that explains why a $4.8 trillion withdrawal from traditional markets is not only plausible, but structurally consistent with the data, even if no single data set flashes red. Start with global savings and reinvestment flows. Across developed markets, institutional investors collectively manage well over $120 trillion in assets. Annual turnover, maturities, coupons, dividends, rollovers, redemptions, and reallocations typically runs at 10 to 15% of assets, meaning $12 through $18 trillion is in motion each year, even in calm periods. If only 25 to 30% of those flows are redirected away from public equities and long-duration bonds into short-term instruments, private credit, or internal liquidity buffers, you arrive at $3 to $5 trillion in reallocation without requiring panic selling. Now look at public bond markets specifically. In the U.S. Treasury market alone, outstanding debt exceeds $26 trillion, with average maturity around 5 to 6 years. That implies roughly $4 to $5 trillion in maturities annually before accounting for new deficit issuance. Add investment-grade corporates, agencies, and foreign sovereigns, and annual bond maturities across developed markets exceed $10 trillion. If reinvestment rates fall from, say, 85% to 60%, the delta is $2.5 trillion per year, leaving traditional bond demand. That number compounds quickly. Equities tell a similar story through flow imbalance rather than outright selling. Over the last decade, equity markets relied heavily on passive inflows and corporate buybacks. In strong years, U.S. buybacks alone exceeded $800 to $900 billion annually. When higher rates raise debt service costs, buybacks slow. If buybacks fall by $300, $400 billion and passive inflows flatten instead of growing, the equity market loses its marginal support. Prices may not collapse immediately, but the market becomes flow negative in real terms, especially after inflation. Now consider private credit and short-duration instruments as the recipients. Private credit markets have grown from roughly $700 billion in 2010 to estimates between $1.7 and $2.0 trillion today, with annual growth rates often cited in the 10 to 15% range. A $200 to $300 billion annual inflow sustained over several years accounts for a meaningful share of the missing capital. Meanwhile, money market funds in the U.S. alone have at times exceeded $5.5 trillion, up from around $4 trillion pre-tightening, a swing of more than $1.5 trillion toward cash-like instruments yielding 4 to 5%. To formalize this, consider 3 labeled scenarios. Scenario A, conservative, bond reinvestment shortfall, $1.5 trillion reduced equity inflows in buybacks, $1.0 trillion increased money market and cash buffers, $1.2 trillion total reallocation, $3.7 trillion scenario B, central estimate, bond reinvestment shortfall, $2.2 trillion equity allocation, reduction, $1.4 trillion, shift into private credit and cash, $1.2 trillion total reallocation, $4.8 trillion scenario C, stress, bond reinvestment shortfall, $3.0 trillion equity de-risking, $2.0 trillion liquidity hoarding, $1.5 trillion total reallocation, $6.5 trillion. None of these scenarios require aggressive selling. They rely on non-renewal, underallocation, and preference shifts. That's why traditional indicators, index levels, headline volumes, volatility averages, fail to capture the change. The system looks stable until it isn't. The key takeaway is this. Traditional markets price risk as if liquidity is elastic, but the balance sheet math says it is not. When capital chooses safety, duration avoidance, and optionality over growth exposure, normal expectations about market resilience break down. The math doesn't predict a crash on a specific date. It explains why the system becomes brittle. When a system absorbs a $4.8 trillion capital shift quietly, the eventual reaction is rarely linear or polite. Markets don't adjust smoothly to missing liquidity. They reprice abruptly when a constraint is hit. The key is understanding why the reaction often looks irrational on the surface but is mechanically inevitable underneath. The first transmission channel is liquidity thinning. As capital migrates away from traditional venues, bid-ask spreads widen subtly, market depth shrinks, and the cost of immediacy rises. On calm days, this is invisible. But when a shock arrives, a weak auction, an earnings miss, a geopolitical escalation, or a policy surprise, price gaps emerge because there are fewer natural buyers standing behind the market. A 1-2% move that once absorbed easily can become a 4-6% gap simply due to the absence of balance sheet capacity. Next comes volatility feedback. Many strategies, volatility targeting funds, risk parity portfolios, CTA trend systems, adjust exposure based on realized or implied volatility. When prices gap and volatility spikes from, say, 12 to 25, these strategies are forced to de-risk mechanically. That selling is not discretionary, it is rule-based. As positions unwind, volatility increases further, triggering another round of reductions. This reflexive loop explains why markets can overshoot fundamentals dramatically in short windows. Credit markets amplify this effect through spread widening. When investors demand higher compensation for risk, investment-grade spreads that were 100, 120 basis points over treasuries can move to 180, 220 basis points quickly. High-yield spreads can jump from 350, 400 to 600 plus basis points. That repricing feeds directly into equity valuations, refinancing costs, and corporate behavior. Even companies with stable cash flows suddenly face a higher cost of capital, which suppresses investment and hiring. Another underappreciated channel is collateral stress. As asset prices fall and volatility rises, collateral values decline and haircuts increase. A treasury that once funded at a 1 to 2% haircut might require 5%. Equities used as collateral may face even steeper discounts. This forces leveraged participants to post more margin or liquidate positions. Again, the choice is binary: raise cash quickly or sell assets into a thinning market. This is how liquidity events propagate across asset classes simultaneously. Observers often misinterpret these moves as panic or irrational fear. In reality, the behavior is structurally logical. When liquidity is scarce, the market clears at prices that reflect who must transact, not who wants to. Forced sellers set prices and optional buyers wait. Correlations that seem diversified converge toward one, because the common factor is balance sheet constraint, not fundamentals. What should observers watch? Not headlines, but plumbing indicators. Bid-ask spreads in treasuries and credit ETFs, repo rates, and funding stress. Credit default swap indices, volatility term structure, spot versus forward VIX. ETF premiums, discounts to NAV primary auction coverage ratios. When these indicators deteriorate together, it signals that the hidden capital shift is becoming visible. This is the paradox. The longer markets appear calm after a large silent reallocation, the more violent the eventual adjustment can be. Stability without liquidity is not stability at all. It's deferred volatility. At this point, the structure is clear. $4.8 trillion has already shifted away from traditional markets through quiet, mechanical channels. What matters now is how and when the system reveals that change. Markets do not respond on a single schedule. They respond when timelines collide with constraints. So the roadmap is not a prediction. It's a sequence of conditional outcomes tied to observable indicators. Timeline framework, next 24 hours to 1 week. Short-term reactions are dominated by funding conditions and sentiment-sensitive plumbing. Any weak government bond auction, surprise policy comment, or volatility spike can expose how thin liquidity really is. Watch overnight repo rates, bid-ask spreads, and ETF premiums. These are early warning sensors, not headlines. Next 1 month. This is where flow data and refinancing pressure start to matter. Treasury issuance calendars, corporate bond supply, and earnings-related buyback announcements intersect. If traditional buyers remain absent, yields and spreads do the adjusting. Markets may look range-bound, but under the surface, the cost of capital is recalibrating. Next 1 quarter. By this stage, balance sheet decisions hit the real economy. Credit availability, hiring plans, and capital expenditure reflect the new funding reality. This is when narratives change, often abruptly, to unexpected slowdown or sudden volatility, even though the setup was months in the making. Scenario 1. Base case. Slow repricing. Most likely. In this scenario, liquidity remains tight but functional. Yields drift higher by 50 to 100 basis points at the long end. Credit spreads widen modestly. Equity indices remain volatile but avoid a disorderly crash. Capital stays concentrated in short duration and private structures. Key indicators: gradual steepening of the yield curve, stable but elevated money market balances, moderate spread widening without funding stress, flat or declining buyback announcements. This outcome feels frustrating rather than dramatic. It is a grind, not a panic, but it permanently resets return expectations. Scenario 2. Stress case, liquidity break. What breaks if conditions tighten? Here, a catalyst hits while buffers are thin, a failed auction, geopolitical shock, or sharp policy surprise. Funding markets tighten rapidly. Volatility spikes from the low teens into the 30-40 range. Credit spreads gap wider by 200-plus basis points in weeks, not months. Forced deleveraging dominates price action. Key indicators: repo stress and rising haircuts, ETF discounts widening persistently, sudden correlation spikes across assets, emergency liquidity language from policymakers. This is where the absence of the $4.8 trillion becomes visible all at once. Prices overshoot because liquidity, not valuation, is setting the clearing level. Scenario 3. Relief case, stabilization, through policy or growth. Stabilization requires one of two things. Either policy eases materially, or real growth accelerates enough to justify higher rates. In this case, some capital cautiously returns to traditional markets, though not at prior scale. Volatility compresses, spreads narrow, and duration becomes marginally attractive again. Key indicators: clear forward guidance toward rate cuts, falling real yields, renewed equity inflows and buyback growth, declining money market balances. This scenario is possible, but it does not undo the structural lesson. Capital will remain more selective and liquidity aware than in the pre-2022 regime. The critical insight is this: market structure now matters more than market stories. When trillions move quietly, traditional signals fail. What looks like calm is often constraint management in disguise. Normal expectations about diversification, liquidity, and smooth adjustment fail because the system is operating under a different set of incentives. This content is for educational purposes only and does not constitute financial advice. Markets involve risk, outcomes are uncertain, and viewers should consult qualified professionals before making decisions.